Welcome to today's session in a lecture on international political economy. Today's topic is transnational production, and the unofficial subtitle goes Capital Without Borders. In the bigger picture, we move further in the dynamics part of our lecture, and please note that this is the last session before the Pentecost break, so next week there will be no lecture, but in 2 weeks' time we will return and discuss the global financial system. Today's session will be structured in 3 parts. First, I will discuss the issue of foreign investment. After that, I'll discuss the most important actors into foreign investment, which are transnational corporations. And finally, I'll give some remarks on transnational production and the current COVID-19 pandemic. So let's begin with capital transcending borders, or as we can also call it, foreign investment. To understand what happens here, it helps to remember briefly how capitalist production works and when capitalist production will take place, because remember, the thing that most people find great about capitalism is that so much stuff is produced in capitalism. So this is something that liberals, so neoclassic liberals and Keynesians and also Marxists can agree on, that capitalism produces a lot of stuff, and this is a good thing. If you are a certain kind of environmentalist or from the post-development camp, then you don't like this about capitalism, but many others do like it. So what do we need for capitalist production to happen? We need, for example, the 3 so-called production factors. So these are capital, labor, and land. Capital means that there will only be capitalist production if there is some actor who, for example, has a lot of money and then invests this money in structures that make production possible. So for example, factories and machinery and so on, and also pay employees so that they can engage in production. And in order to do this, you also need labor, which means you need human beings that are willing to engage in wage labor and are willing to do the production in the factories of those who have the capital in return for the wages they get. And finally, you always also need some kind of land, and this of course strongly varies. So if you are an agricultural company, then you typically need a lot of land. If you are in the heavy industries, then you need some land where your factories and your storage facilities will be built upon. And if you are in the digital industries, then you probably need typically a lot less land. But even if you are a company that only works with the personal notebooks of their employees, then you probably still need some place to put those notebooks and the desks and the chairs, and you typically also need some server space, and the server also has to be somewhere. So in order for capitalist production to happen, you need these 3 things. However, just having some capital and some labor and some land does not mean that there will be capitalist production that will actually be useful for anyone. In order for this stuff to become useful in production, you need some other things. So for example, if you are a capital owner, you will only invest in production if you have the expectation that there will be people who are willing to buy your product and we also have the money to buy your products. So that means you need demand, and this demand does not help you if it's just somewhere out there. You also need to have market access, which means you have to have a way to get your products to these potential customers. Then you also need supplies or materials. So laborers cannot just produce stuff from nothing. Typically you need some raw materials or something like that, or some manufactured good that you then process even further. So you need that too. Then you need to have a certain base of knowledge that will give you the possibility to create competitive products. So even if you have all the money in the world and you have labor and land and all that, you will still be unable to be successful in the telephone market if you don't have the engineering knowledge on how to create a smartphone that people actually want to use and that can compete with the big players on the market. So you also need this kind of knowledge on how to develop competitive products. You need to be able to produce them at competitive prices, because if your prices are too high, then no one will buy it. And if you just lower the prices and this means that you don't make any profit from your investment anymore, then investors wouldn't invest in the whole thing, would not work. So the overall constellation has to be that the prices must be so low that people are buying it, and yet they must be high enough for the investor to make a profit, and still be able to pay their wages and so on and so on. And finally, this all can only happen if there is some favorable political framework, which means as an investor you have to be sure that if you invest your money somewhere, the state will not just take it away, but there are legal norms in place that will guarantee your investment and also will guarantee your ability to sell the stuff as you planned it. And also workers might have a better incentive to go to work if they have a favorable framework for them. So this is basically what you need in order for capitalist production to emerge. And today we will focus on the question of capital and on a specific thing that capital might do. Next week, in 3 weeks we'll focus on labor, but today is a session on capital, and we specifically want to ask what will make capital transcend borders or cross borders. So under which circumstances is it likely for capital not to invest in the country where the people who have the money sit, but rather that those who have the money take this money and put it across the border and invest it in some other country. So first we discuss in what ways can capital cross borders. And in general we distinguish two kinds of foreign investment. Foreign investment is just another term for capital crossing borders. So on the one hand we have foreign direct investment, on the other hand we have foreign portfolio investment, which is also known as foreign indirect investment. The main distinction between the two is that in foreign direct investment, the capital that is invested abroad will give the investor some control, or at least some significant influence on the production that will take place in the host country. So you invest money there, and then you have the chance to decide on how stuff will be produced there and what will be produced there and so on. With foreign portfolio investment, you also invest the money in another country, but then you don't really have a chance to make decisions of what happens with the money. And put more concretely, there are a couple of forms in which foreign direct investment can take place. So the thing that's possibly the easiest way to imagine it is if a company in one country decides to open a branch in another country and then buy some land there and build a factory on that land. And for that, of course, they have to transfer money there. So let's say you are a French company engaged in car production, and you think, well, I want to have a Chinese branch. So you buy some stretch of land in China, and then you invest a couple of millions or billions of dollars, and then you build your factories and so on in China, and then you become transnational, and then you have invested money there. And then of course you are able to decide what will be produced in these factories. So what kind of cars or what kind of parts of cars and so on and so on, and also how they are produced. You can also reach a similar effect the second way by just buying some company that was already there. So you already know, well, there is this Chinese car manufacturer, and we have the money to buy them, and the Chinese government allows us to buy them. Then you could, in theory, just buy them as your French car company, and then you also become transnational and have a rather similar effect, but you reach this in a different way. And there are also smaller ways in which you can do it. So maybe you don't just buy the whole company, but you only buy a certain percentage of the company. So you buy maybe 20% of all the stocks, and then you already have some say in what will be produced there. And typically you say that for this kind of investment to be counted as foreign direct investment, it has to be such a share of the stocks that you have some influence, and typically the border is at 10% of the company that you have to buy for it to count as foreign direct investment with sufficient influence. And a final form of foreign direct investment is if you already have facilities or something in this other country, and then you just transfer money there to expand production over there. So you already have built your car factory in China, and now you think, well, we need new and better machinery in this car factory, and then you also have to invest more money there. So capital will have to cross the border to China for this to happen. So it's also foreign direct investment, because afterwards you have the chance to influence or control what will happen there. For foreign indirect investment or portfolio investment, there are fewer ways in which you do this. Basically, it always means buying some kind of financial product that will give you some share of businesses there, but this does not come with influence. And these financial products can be stocks or bonds. So it can be that you buy pieces of paper which make you a partial owner of this company, or it can be pieces of paper in which the company say they owe you money, or it can be other kinds of financial products. And as long as your share in the company remains below 10%, then we would say you have no control or influence there, and then it counts as indirect investment or portfolio investment. So what happens with these two forms of transnational investment? In general, it happens what happens with all investment. You invest money, which means you inject capital somewhere, and then you hope that you will extract profits afterwards. So in general, no investor that can be called an investor would put their money somewhere where they don't hope to gain even more money afterwards. So this is the basic rule of capitalism and how it works. So you invest money and you extract money, and this works with direct investment as well as with indirect investment. With foreign direct investment, you would have some production facilities there, and they produce stuff, and then you sell the stuff or use the stuff, and then you make profit from that. And with foreign indirect investment or portfolio investment, you put the money there, and then you just lean back and wait for the money to become more money. So for your bonds to be repaid with interest, or for your stock prices to increase, and for dividends to be paid out. So in both ways, you as an investor hope to make more money from your investment. The differences are, as I said before, in the one case you wield influence over the production, in the other way you don't wield this kind of influence. And it also means if you are a corporation beforehand, if you do foreign direct investment, you probably gain proximity to the market there, and it might give you a route to gain market access. With foreign indirect investment, you typically don't get any nearer to any foreign markets. Also, with foreign direct investment, there will be some flows of knowledge. So if you wield control over production there, then you have to tell people what to produce there. So you have to transfer the knowledge on how to produce your cars or car parts to that other country. And maybe people in the country will therefore learn how to produce this. But it can also work the other way around. So in the simplest case, you might only learn what kind of cars Chinese customers like to buy, but also it might be that if you buy a Chinese car manufacturing firm and they have also certain knowledge on how to build cars that you have as a French firm might not have had beforehand, then you also buy this kind of knowledge. So there will be flows of knowledge, but if you only buy stocks, then there is no flow of knowledge. Finally, the last difference I want to name here is that of the volatility of this kind of investment. So this means how likely is it that the investment will be withdrawn quickly and flow in and flow out very quickly. With foreign direct investment, the volatility is typically not very high, because if you buy production facilities in a different country, then you want to have those facilities, and then you have those facilities. So it's very hard and expensive, and you have high transaction costs if you just decide the next years, oh well, I don't want these plants in China anymore, this will have cost you money, and this happens sometimes. But if you are a transnational corporation and you engage in this investment, you typically in the other country for a longer time. And there are some forms and some investors who have different aims and who just want to buy some companies somewhere else and then split them up and then sell them for scraps, but that's not what we're talking about right here. With foreign indirect investment or portfolio investment, there it's different. There it might very well be that this year you think, well, the Indian market is so interesting, I'm gonna buy a lot of Indian stocks, and then there are some forecasts that India is gonna face some big trouble in next year for whatever reason, and then you just say, well, I sell these stocks, or you sell, well, I don't give any more bonds to the Indians and I want my money back. And so you have it much easier to withdraw from these markets where you invested your money, so there is higher volatility there. So capital is a very shy animal, and with portfolio investment, this shyness will actually have effect. So what are the reasons for capital to cross borders? First, look at this question in general. One of the most important points here is what we call economies of scale, and this refers to the question how much of a product you produce. And in general, it is the case that the more of a certain product you produce, the cheaper it becomes. So, and this also makes you more competitive, of course. So if you develop a certain model of car and then you only produce one of these cars, then this car will probably cost a couple of millions of euros, if not even more, because the research and development costs for developing a new model of car are so high that this is what one single car would cost. If, however, you produce 1 million of these cars, then the share of the research and development cost will be much lower, and then you probably only have to pay for the labor hours that go into it, and also for the raw materials and so on. And so the overall price declines, and even with those sheer production costs, even they will decline if you have big machineries and very routinely operated production lines. Then the individual car will become cheaper and more competitive. And if you are, let's say, a French car producer once again, and you only produce cars for the French market, there are only so many consumers that you could reach, and so your economies of scale will not give you an advantage, and you'll have a big disadvantage as compared to American car producers who have a much bigger market domestically. And as soon as there are some markets where you two compete, then you're instantly in the disadvantage. So what you will want to do then is then to also try to expand to not only the American market but to all kinds of markets, and then you can work with economies of scale, and then your products become more competitive. And this is particularly, of course, important if there is competition in the market. And it also works with two manufacturers from the same country. If one of them expands abroad, they will benefit from economies of scale and might be able to outcompete a competitor who does not expand abroad. A second thing that comes with foreign investment, and this is also true for foreign portfolio investment, is the diversification of risk. So if you are only invested in one country and there's a crisis in this country, then this is very bad for your investment. However, if your investment is spread out over 50 countries on 5 continents, then you have a high chance that even if the most dire crisis in one country, that you still have something of your investment in the other countries, and if there's a global crisis, then there's a global crisis. However, your overall risk declines the more wider spread your investments are. Next thing, and this once again mostly relates to foreign direct investment, is the access to new markets. So you can of course also produce cars in France and then ship them to China and the United States, and this could give you some effect with the economies of scale. However, then shipment costs will be added up to your product, and maybe if China or the United States or both of them have tariffs on foreign cars, then you also have to pay the tariffs, and then your cars might not be competitive in these markets. If, however, you buy production facilities in those markets, so in China and in the United States, then you can just produce there, and then you don't have to pay tariffs in these countries for these markets. So the foreign direct investment gives you access to these new markets. Another effect might be that you just lower your production cost, and this is particularly important for labor intensive industries. So if you are a company that produces textiles and you produce it in a country where labor costs are rather high, such as Germany or most developed countries, then your shirts will probably not be competitive, or only for the very high price range. If, however, you move production to other countries such as Bangladesh or Turkey or Sri Lanka, then you will be able to produce at cheaper cost, and then your products will become competitive. Finally, it might also be the case that you just try to invade certain regulations that are also costly for you. So for example, workplace safety regulations. So if every worker needs so much space and breaks and all these other annoying things, annoying for employers, then you might move to a country where there are less annoying regulations when it comes to workplace safety, and this will lower your cost. Something similar goes for environmental costs, but you can also try to avoid taxation by transnationalizing. So there's a lot to win for companies. But this is only when it comes to crossing borders in general. We also can ask what will cause a company to invest in a specific country. So what's important here is that this country either has a big new market or is at least close to a big new market. So in the last couple of years or in the last 2 decades, many companies invested in China to some extent to produce there and then export to the rest of the world, but also because they saw that China is an emerging market, that there are more than 1 billion people living in China, and so they figured, well, this is going to be an important market, so we want to take a foothold there as soon as possible, so they invest there. But it doesn't always have to be the country where the market is. For example, if you want to have access to the German market, basically any country in the European Union will do, because the European Union is a customs union. So you don't necessarily have to invest in Germany. You could also invest maybe in Hungary, which is pretty close to Germany, but where your investment might be cheaper, or you invest in the Netherlands where taxes are lower or something like that. So this might be important. It might also be important to move your production to a place where there are suppliers. So it might very well be that you can very cheaply produce or assemble cars in, let's say, I don't know, the Congo or some whatever sub-Saharan African country you choose, where there's some stability, and so you would be able to pay workers there to assemble your cars. However, those manufacturers of car parts, they're not anywhere near that, so you typically only have this kind of investment in a country where there are suppliers for what you produce there. The next thing is the kind of labor that you have in this country. So there are different demands for different kinds of production. the two things that companies typically look for is a cheap labor, so where you have to pay low costs, or skilled labor that will be very productive. And the best, of course, is a labor that is cheap and skilled, but typically it's a trade-off between the two, because those who are more skilled will typically also demand higher wages. Then you only want to move to countries where there's a good infrastructure, so where the supplies can be shipped in easily, where your workers can live, particularly high-skilled workers can live, because they don't live everywhere, and also where it's easy for you to ship your products from this production facility. Then you would only invest in countries where you think there's a political or legal framework that is A, reliable, and B, favorable. So you don't want to invest somewhere where you might think there's a risk that there will be a civil war next year, or that there will be a government that will nationalize your facilities next year. So you don't want these things. And on top of these things, you probably would want some legal framework where the state is very, very friendly to businesses. And this also relates to the last point, which means you probably want to move somewhere where there are low taxes and where there's a little regulation, as long as you have a choice. And of course, this is kind of the wish list that corporations might have. Typically, they have to make trade-offs here, so they have to accept that there are some taxes in exchange for having some infrastructure and so on. Now, what are the effects of capital crossing border, particularly in the form of foreign direct investment? Here, on the one hand, we can tell a very optimistic story. So if we are optimistic, we say, well, foreign investment will help developing and least developed countries to overcome one of the biggest burdens there, which is a lack of capital or a shortage of capital. So what most developing countries have is a big underemployed labor force, and they typically also have quite a lot of land. It varies from country to country, but in general there's land and there's labor. But the production factor that most least developed and developing countries don't have abundantly is capital. So if there's foreign direct investment there, then all three production factors will be there, and production and development finally can take place. Then you can also say, well, this will produce jobs here. So if the labor force was underemployed before, now there is employment and people will have jobs, will have money, will be able to consume, will be happier. So that's good. Then there will be a transfer of knowledge. So the workers will be trained. They will learn what you need to produce good cars or good telephones or whatever. And also the businesses that are around there will also then be able to employ this workforce maybe. This whole production will generate taxes, so even if the companies themselves might not pay that many taxes because they have to be lured in with low tax rates, they will have employees, and these employees will pay taxes, so the state also wins. Then the workforce becomes more qualified, and this is also good for production there. There might be new opportunities for the local businesses that might act as suppliers, for example, of the production facilities, or at least maybe supply the now richer workers with stuff that they need. At the very least, it might be that the agricultural production in the country will have more to sell to the workers and to those who are employed at these new plants. Next point is there will be an increased international connectedness of the local economy. So if there are these transnational corporations in the country now, then all local businesses might have also better access to what's going on in the rest of the world, in the world of business, and maybe they will also be able to build export industries that are competitive on the world market. Because what we also hope that this being in the context of the international market and being exposed to international markets will make local businesses more competitive. And these are, of course, also the ingredients for capitalist development to happen. So in this very optimistic view, a lot of foreign direct investment will cause development in the country, and then the country can take off and become an industrialized, developed country afterwards. However, you might have guessed, if there is an optimistic view, there's also a pessimistic view. And then you can say, well, this foreign direct investment does not really help overcome the shortage of capital here, because in the worst case, these companies only employ some low-skilled workers there, and then they will just ship in some raw materials, have those low-skilled workers work there, ship out the materials, and take all the profits with them. And you have that in some industries, in the textile industry, also to some extent in the tourism industry, where just not much will stay in the country, and there will be some production there, but the country will not benefit. So the investors just ship in their capital and take out the profits, so not much will stay in the country. The jobs that are created in this kind of foreign direct investment are only low-paying jobs, so the population will not really benefit from it. There will also be hardly any meaningful transfer of knowledge, or maybe there will only be extraction of knowledge. Then the companies will not pay taxes, they will evade taxes, and also if they only employ low-skilled workers, then these also won't be able to pay high taxes, so the government revenues are next to zero. This kind of investment will also leave the workforce unqualified. There will be no meaningful engagement with local businesses, and those connections that the local businesses will have to the international markets, if they are there at all, and if this not all happens on some de facto island without much connection to the host country, they might even harm local businesses, because now there is competition and the local businesses don't learn anything, they just die, and thereby this kind of foreign investment might not lead to development, but rather hamper or destroy the local economy. And I think the two authors of a textbook, O'Brien and Williams, make quite a good case that this is not an either-or kind of thing, where it's either the one thing or the other thing. It's rather that we have evidence and we have cases for both kinds of developments, and the question has to be not, is foreign direct investment good for development, or is it bad for development, but we rather have to ask, under which condition will the good things happen, and under which conditions will the bad things happen. And very, very schematically, we can say, well, on the x-axis we have the question of openness, on the y-axis we have the question how successful this kind of development strategy will be. So on the very left side we have companies who are trying to have a capitalist development in isolation from foreign capital. And if you look at the history, there are some examples where you might argue that it worked over here if there are otherwise favorably conditions. But for the least developed countries in the world, this is not a very promising path to development. So without any contact to foreign capital, I don't know, Sudan will never ever become as developed as Germany or the United States or whatever. So developing in isolation did not prove to be a very good strategy. So that's why it's low on the y-axis. On the other hand, then we might say, well, then open the floodgates, let all the companies in and invest under the best circumstances and do everything to get the foreign capital to your country. However, just opening up everything and letting them in and letting them do what they want to do typically also doesn't lead to successful development. It rather oftentimes leads to the negative effects that I just described. So then the pessimistic view will be confirmed. What we have, and this might seem like a lame middle ground or golden middle kind of argument, but however, there is good evidence if we look at the countries of the former so-called third world, but also if we look at the countries in the former so-called second world, so the transitional post-socialist economies. Typically always those countries fared best that did attract foreign capital and foreign direct investment, but also created some clearly defined framework that ensured that there will be at least some high skill and high value added jobs in the country. So there will be some qualification of the workforce, there will be knowledge transfers, and that local companies will be involved with the transnational companies. Because if as a government of a host country you have something to offer to the transnational companies, and then you engage in certain negotiations and make clear that in order for you to let these companies in as investors, that they have to meet certain requirements, then they might be forced to do so, and then your economy might benefit from this kind of foreign direct investment. And if you look at the case of China, at the case of Singapore and other countries that recently had high growth rates, this is typically what they did. So they did not just open up, no question asked, and they didn't just leave foreign capital out. Rather, they let foreign capital in under certain circumstances. However, we have to ask the question whether everyone can do this, and also whether everyone can do this successfully at the same time. Because of course, on the one hand, you have to accept that the leverage that governments will have differs greatly. So a country like China with 1 billion plus people will have more negotiating power vis-a-vis a transnational organization than a very small, very poor country. And even if we don't account for this, we can also still ask, well, can everyone take this kind of position at the same time? So if all economies have this approach that they say, well, you can get in transnational corporations, but please do your high value added jobs here, then the question is, can the transnational corporations really do this high skilled steps of the production in all the countries at the same time? Or is this sort of a problem where only some are winners and others have to be losers for these some to be winners? And it's not quite that simple, but it's again somewhere in between there. Now, at the end of this part, some empirical recent data on foreign direct investment, and this comes from the World Investment Report by the United Nations Conference on Trade and Development, which is published once a year. So this is the most recent version from last year. So how did foreign direct investment develop over the last 30 years or so? In general, we can say, so the green line here is the investment inflows total for every single year, and the yellow or orange line is somewhat normalized to cut off the peak. So they calculate that this is the general trend underlying these concrete developments, because there can be rather big jumps if a very big corporation buys another very big corporation in another country. Then this might be a deal worth billions of dollars. So, and this will be visible in these kinds of charts if some of these events happen. So you calculate out those peaks, and then you get a smooth line. And what you see there is there was a big growth in foreign direct investment in the 1990s, where there was a growth, so an annual growth of 21%. If you look at the 7 years after the millennium and before the global financial crisis, we have an annual growth of about 8%. And if we look at what happened after the global recession of 2009, then we only see an annual increase of 1%. So there is still a lot of foreign direct investment every year, and there is probably 10 times of the annual amount of foreign direct investment than what we have in 1990, but it doesn't grow anymore. So it's rather constant, and for certain this year there will be a sharp decline, because this is typically not the time where transnational corporations will make very big investments if they don't know what's happening in these other countries, at least not across the board. So in what countries do these investments take place? So here we have in gray the total amount of foreign direct investment inflows. In green we have the inflows to, so in dark green, the inflows to developed economies. In yellow orange we have the inflows to developing economies, and in light green we have the inflows to transition economies, which are the post-socialist countries, which does not make a lot of difference in this graph. And here we see that it's roughly half goes into developing countries and roughly half goes into developed countries. And what we also see is that the volatility here is much higher for the investment in developed countries, which is, as I said, probably about big mergers and acquisitions between corporations that will make a big difference in these statistics. And if you thought before that foreign direct investment is typically something where money from rich countries is invested in poorer countries, then you have to think again. So you already get a certain impression of this here, but it will become much clearer if you look at this chart, which lists on the left side the countries where the money is invested, so FDI inflows, so where do transnational direct investors invest their money. And there you see by far the country that attracts the most foreign direct investment has been for a very long time and will probably remain for quite some time the United States. And why is this so? It's of course so because the United States are the biggest market in the world still. So the European Union as a market is somewhere close to it, but the United States are still by far the biggest market when it comes to the GDP. China gets somewhere near there, but the United States is still the most important. So this is where investors want to invest. But after that comes China, and then Hong Kong, which is China once again, and then Singapore, which is not quite China. So, but you see there's a certain pattern there, and then comes the Netherlands. And now you might wonder, why on earth the Netherlands? And it's pretty much what I just described before. The Netherlands is of course part of the European Union, and the Netherlands have a tax system that makes it very attractive for transnational corporations to have their European center in the Netherlands. So quite a few transnational corporations will have the seat of their European Union branch in the Netherlands, because there they have a rather highly trained workforce that will be able to speak English, but they also don't have to pay very high taxes, and from there they can access the entire European market. So the Netherlands are very attractive here. You have similar developments in Ireland. So this is where the money flows, and where does the money come from? Here you see that Japan is a very important player as the origin of foreign direct investment, and here the main reason is that there are very important, very big transnational corporations that have their main seat in Japan, and whenever they invest somewhere else, it's counted as money coming from Japan. But then we also have China, France, Hong Kong and Germany as other countries which have important transnational corporations and are therefore important as sources where foreign direct investment is flowing from. On the next chart, we look at how governments regulate investment policies. And here you see the development in two kinds of legislational changes. So here all changes in legislation referring to foreign investments are tracked and then categorized in either policies that make liberalization or policies that make restrictions or more regulation. And as you see, there are still far more liberalizing policies than regulating policies. However, over the course of time, there seems to be a certain tendency towards making not so much more liberalizing policies. So the edge that liberalizing policies have of regulating policies, this is in decline, and this is of course only the growth of the growth that's declining here. Here, next chart that I want into details here, what you see here is the number of IIAs, and IIA means International Investment Agreement. So these are agreements between certain countries how to deal with international investments. And we see that in the 1990s and in the early 2000s we had a lot of these agreements. If you look at this, those are more than 200 per year, so roughly 4 per week. And in the last couple of years we only had less than 50 per year, which means less than 1 per week. And this in part is because there's a certain saturation effect. So of course, if a lot of countries already have foreign international investment agreements with one another, they don't have many reasons to create new ones. However, it also means that you see there's this sharp decline after 2009. That is also as an effect of the crisis, that international investment doesn't seem to be something that needs to be expanded that much anymore. Finally, this statistic refers to something that is discussed at length in the text. These are special economic zones, or SEZs. And what we see here in green are the number of countries in which these special economic zones do exist. And here we see in 1975, not even 30 countries had an SEZ, and in 2018, almost 150 countries in the world have at least one SEZ or more than that. So that's at the moment roughly 3/4 of all the countries in the world. And if you think in terms of population, it's even much more than this. And in the yellow bubbles, you see the total numbers of SEZs. So they started with 79 in 1975, and now they're up to 5,400 overall.